direct tax impact on joint development agreement and indirect tax implication in case of a joint development agreement. Then say just prior to the provisions of a joint development agreement, just I am giving a brief history. The issue was the landowner, the owner who is in possession of the land or the owner of any building. It may be land, it may be building. In case of land, the landowner gives the land rights to the builder, or we can say the developer who can develop. And while the land right has been given, it is followed by power of attorney, and the compensation has been given or the consideration has been given, maybe in kind or cash. And prior to the introduction of Section 45A of the Income Tax Act, so department, particularly I am talking income tax department, took that any immovable property in case of which power of attorney has been given to the developer, it is a transfer and the capital gain has been arise immediately. When the 100% consideration has been received, so there was no issue for payment of the income tax by the landowner by computing the capital gain, and there is no issue at all. But when the consideration is received, maybe partly cash, partly kind, or maybe full in the kind, there may be possibility of a full consideration in the kind. The issue is the consideration in the form of a flat or the some part of the building which is would be constructed by the developer, maybe coming after 2, 3, 4 years, maybe longer than that, depends upon the efficiency of the developer. But in that case, the transfer is subject to the capital gain tax. So this issue was number of controversial decisions before the introduction of Section 45A, and to avoid the dispute, taxability at the time of giving right to use of the land, or in case of power of attorney, or it will be only on the handing over the flat on a point of occupancy certificate or certificate of completion. So to avoid these disputes, since number of controversial or contradictory decisions of the different courts authorities are there, so the Section 45A was introduced. This is the background of the history. So that's why the joint development agreement concept has come out. So before going for the discussion in the tax implication of direct taxes, indirect taxes, the time is very short, but I will touch upon the important points in my slide so that give an overview of the taxation. Then say what will happen? What is meaning of joint development construction, joint development agreement under which the developer is constructing the house? So that is the very important. Landowner is having a land. The landowner is the sole and absolute owner of the land. The developer or the reputed developer generally to be chosen by the landowner, and it may be a real estate project developer generally preferred, and the landowner intended to construct the house or some of the flats on the land belongs to the landowner. The landowner agrees to provide the developer with the right to construct a building over the land which he is in possession, and this is commonly referred to as a joint development agreement. The agreement has to be made by the landowner and developer, and the landowner may receive the consideration 100%. So when 100% received, we cannot say it is a joint development agreement because there is no flat is going to give in. Generally, it is maybe 100%, maybe the building. Then it may not be, we can say it is a joint development agreement because the entire building will be handed over to the landowner. So there may be a proportionate, so it may be any proportionate depending upon the situation of the land. So some cases the land right is given, let in this example 40-60%. Let I'm talking if the land is situated in a very reputed place of in the urban city, you will find maybe 70% may be given to the landowner, 30% maybe the builder. So it depends upon the situation and negotiation. So that agreement is known as the joint development agreement. And on joint development agreement, both income tax and direct tax implications are there. So in case of indirect tax, we will discuss the different types of projects generally taken place: residential project, commercial project for the leasing. So the different projects may be taken off. So there may be another type of contract which is known as revenue sharing. In the revenue sharing, the land will be given. So the consideration will be the whatever profit surplus will come, that is known as the revenue sharing. So in this concept, we are going to discuss the topic in detail. Before going for the discussion, some of the important terms which we can see or discuss also. Joint development agreement, already I told, it is an agreement, and that agreement is required to be registered, and it lays down the responsibilities of the landowner, and the responsibilities of the developer, and the portion of the details of the sharing of the outcome of the development, that is the building, maybe residential building, maybe commercial building, maybe residential commercial building, both the share that has to be incorporated. So that joint development agreement plays very important role for the purpose. And there is a allocation agreement. Suppose the landowner and the developer made an agreement, so their obligations has been specified, consideration has been specified, maybe in the cash along with the sharing of the building or the flat, or it may be some advance given at the time of signing of the agreement or before the handing over the general power of attorney, which is on basis of which the land right has been transferred, and that will be there. So the allocation agreement subsequently will come when the town planner has approved the project. So the proportionate which flat will be given. Suppose the landowner has given the land, the builder has going to construct let 4 towers. So in 4 towers, which house the proportionate let will take 40%, 60%. So what are the 40% houses to be given? So which flat to be given? So it will be known as your allocation agreement. The builder subsequently cannot go back saying that no, this flat I will not give, this number flat I will not give, this particular identified flat I can give, not give, and in place some other flat, he cannot do that. So that's the allocation agreement plays very important role. And the general power of attorney, already I told you, once a power of attorney is given, what act will be done by the receiver, the developer, as if the same act has been done by the landowner, and basis of which all the rights have been passed to the developer for the taking step, that means planning, engineering, getting the approval, and then starting the construction, then selling the his own share of a flat, handing over the flat to the landowner. So that's why general power patronage basis the work can be, construction services can be provided or carried on. Then commencement certificate. So once the flat is completed, the commencement certificate will be given when the work the authority has to signify that project has to meet the legal prerequisites. After that, certificate allows the developer to begin the work, and after the completion certificate will be given by the planning authority. Generally it is the municipality corporation or the development authority, depends upon the state to state, and on basis of which the work has been the flat can be sold or transferred to the allotee in case of a sold to the selling of the flat, and similarly it will be also handed over to the landowner. So these are the very important documents you can keep. These are the important provisions, because the Act plays very important role. And you know that in 2019 there is a notification based on when this has been decided, and a number of notification has come. Tax structure, particularly GST has come, but income tax has a different tax structure. So these are basic concepts which you have to keep, and which will be taken in both Income Tax Act as well as both in the Indirect Tax Act, or we can say GST Act, CGST and State GST Act. So promoter, already I told, the developer is the promoter who has undertaken the construction of the apartment and subsequently selling. The project is it a real estate project or residential real estate project, and a real estate project again defined that a development of a building or a building consists of apartment converting an existing building or part of into apartment. Again, I'm telling many cases you will find land has not been given, but old houses has been given. Suppose a cooperative society is there where 100 flats are there. So in that case, what happens? The cooperative society individual flat owners can also hand over the land along with the flat to the developer to demolish the same and construct a new flat and apartment and can hand over. That can be also one of the real estate project which can also cover. And the notification plays a very important role. Particularly you can refer to the notification number 3 by 2019 central tax, where number of changes has been made and number of conditions has been put on. So practically all the details particularly is not possible within the 1.5 an hour, but I am trying to cover both as much as possible in this respect. Then the key milestone of actually when there is a the landowner transferred the land to the land right to the developer, generally the consideration is given in the cash, there is no issue at all. But when the consideration is received in the kind, so in that case the flat valuation has to be made as per the income tax provision as well as at the same under the GST provision. So there is a provision contained in both the acts which we are going to discuss. So executing JDA with the other documents, sale nearest to the JDA date, joint development agreement, which date the sales has been to be taken place. Actually, again, I'm talking. We will discuss some of the important terms. The TDR development rights, which we can say, and the FCI floor space index basis, certain calculation will be made, and subsequent sale of units. So how it will be determined? Sale closest to the occupancy certificate or the construction certificate, completion certificate, that too has to be taken into consideration. Completion certificate and all these things we will also repeatedly discuss because these are the very important points. Value on the date of completion certificate. Just 1 minute. Please 1 minute. Sorry. So these things, the value how to determine in case of handing over the flat to the owner, and because that will be taken by the owner for the determination of consideration and computation of capital gain. At the same time, the value which will be taken for the on which GST is to be paid by the owner, landowner. So that has to be taken. Actually, the issue particularly under GST Act is very complicated. The reason is when the land has been transferred, the land right has been transferred, how it will be tax impacted in the hands of the developer. Second, the construction has to be taken place. So the construction services, when the promoter is giving, how it will be taxable. Third, when the unsold houses remains, because under the GST Act, once the house has been completed, it becomes immovable property, and in that case, immovable property, selling of immovable property is not subject to the GST. But under the notification, there is a provision that unsold houses, how it has a tax impact. Let a builder constructed 100 houses, 40 houses given to the landowner. So landowner has to take the value on the date of completion or occupancy certificate, and that value how to determine will be discussed separately. Similarly, out of 60 houses, let to take the builder already sold 40 houses, already booked 40 houses, 20 houses not booked. So the 40 houses which booked, it will be on that since it is a construction service, so that is subject to the tax from the allotee. But in case of 20 unsold, so how the tax has to be paid by the builder. In addition to once let you take a land has been given, and on that land let 10,000 square foot houses has been constructed and permission has been taken. Subsequently let you take a regulator, particularly regulator or the development authorities or the municipality corporation, those who are approving authorities has also changed their provisions, and they are allowing to construct another 2,000 square foot. So in that case the complication is if the JDA agreement contains that okay additional full space construction, that is also sharing. So again 40% will go to the landowner and 60% will go to the your developer. So again the developer has to also sell it. So in that case how it will be taxable. So all these things to some extent I will cover in this respect. So let us first come to the what are the supplies involved, particularly in joint development agreement? Transfer of development rights, already I explained to you. Supplier of service is the landowner, and the recipient of service is the promoter. So first is development right is subject to the tax. So tax under the indirect taxation. Provisions of a construction service, actually supply of service is the promoter, and the recipient of service is landowner. And when it is sold to the end customer municipality, the third item will come the promoter. Both cases, second case it is the recipient 40%, in my example is the recipient, and there is also supply. And in case of given to the allotee, let what 60% houses which will be taken by the promoter, so they are again selling it to the allotee. So in that case the third party will be the recipient of service and the promoter will be the supply of service. And sale of units to the end customer on a landowner, maybe the supplier. Actually landowner generally whatever 40 plus taken, sometimes they also sold 15 to 20 that and remained they are keeping 20. It means happens that they may be selling entirety also. So in that case the supplier of service is the landowner and the recipient is the third party. So these are the generally involved in case of indirect taxation. But in direct taxation, actually transfer of rights, when the land has been transferred with the power of attorney, so there is a transfer, and which is subject to the section 45 of the Income Tax Act, and the recipient is the promoter, and who is required to pay the consideration, maybe cash and kind, and how it will be taxed in the cash and kind. So let us first take off in the case of income tax. So these are the brief background I have given. Then I am quickly going to the income tax provisions. And again I am telling in case of capital gain, which I just explained to you in case of joint development agreement. So that is only applicable in case of landowner is the individual and HUF, and it is not extended to other than the individual and HUF. So only the joint development agreement under Income Tax Act will be covered in case of individual and HUF. In case of other assets, so there is no joint development agreement. It will be treated as if it transferred, and capital gain will be regulated other than 45A. So what is meaning of what is the 45A? Section 45 contains the provision regarding the transfer of capital asset. So capital asset has been defined, and certain exclusions are there: stock in trade, agricultural land, stock mostly the there is separate definitions are there which is not capital asset. So capital asset is tangible or intangible assets other than the asset which is excluded from the definition. So land, since we are discussing about the land and building, so let us concentrated to the land and building. So land and building are immovable properties, and when there is a transfer of land and building, so on that transfer the capital gain will arise. And in case of short term capital gain, short term means where the land and building will be transferred within the 24, actually it was earlier 36 months, as I remember it has been amended to 24 months. Please check of it. So in that case, the transfer will be treated as a short term and a capital gain will be short term capital gain. But in case of more than 24 months, previously it was 36 months, and as I told you, just have a check at your end. So it will be treated as a long-term capital gain, and a short-term capital gain, long-term capital gain will be taxable at a different rates. So short-term capital gain will be taxable at a normal rate, as a usual normal rate, what is applicable to you with slabs. But in case of long-term capital gain, it will be taxable at a flat rate, and you know that up to 23rd July, as I remember, 2024, the budget amendment which is made effective, and a budget amendment proposed certain provision that no indexation will be allowed in that case, and 12.5% is taxable. So now it is applicable. If indexation is there, suppose I am telling anything transferred earlier, so in that case, the normal the 10% is applicable, but now it is taken as 12.5% without any indexation. And the term transfer has been defined in the section 247, which includes also sale, where entirely it is transferred, it is exchange, it is relinquishment, and the capital, the term transfer is very quite wider, and it is generally the Transfer of Property Act plays very important role. For your kind information, when the power of attorney has been given, it is also treated as a transfer. And as in the beginning I was explaining to you, the dispute was concentrated prior to the amendment or introduction of 45A was on the on the giving of the power of attorney, whether you receive consideration, not receive consideration, but it was treated as a consideration for the purpose of a computation of a capital gain, and you are liable to pay the capital gain. So, but you don't have any money because no consideration you received, but still you required to pay. But under the joint development agreement, it is deferred. So that means the capital gain will be computed, but the tax payment will be deferred depending upon the consideration you received. And if the consideration you received in cash on which the TDS has been deducted, that will carry forward to the year in which the house will be going to be completed. Suppose I am telling I made an agreement, joint development agreement, let it in 30th June 2024, let you take example, I received the 20 lakhs tax on which TDS is deducted. So I am not going to compute the capital gain during the 23-24, and I am going to compute only the year in which a house is to be computed. Since the TDS is deducted, I will show as a TDS, and it will carry forward to the year, up to the year in which it is going to be completed. So 23-24 you are not going to compute capital gain. 24-25 we are not going to compute the capital gain. Let to take on 7th December 2026 you are receiving the flat because of completion certificate has been received by the builder. So in that case 26-27 you are going to compute the capital gain, and in that case the consideration will be determined on 7th December 2026. So that will be discussed, and while you are computing your consideration, you have to take into consideration the flat value converted to the consideration as per the provisions of the law, and plus your cash whatever you received, that also added there for the finding the consideration. Then the indexation to be applied, but since the amendment already made, without indexation 12.5% is there, then you can also apply that. And then another very important point is you just see clause 4 of the section particularly says that any transaction allowing possession of any movable property to taken or retained in a part performance of the contract under section 53A of the Transfer of Property Act. So what does it mean? That means actually what happens, sometimes it so happens that uh, before getting the possession, or you have given the possession but the registration has not been made, but once you have given the possession and receive the consideration, or the consideration is receivable, but still it will be treated as a transfer, and the capital gain is going to be computed on the date on which possession is given to the recipient. So that is very important. Always the transfer of the landowner or the building owner takes the plea that it is not registered. So registration is not a first important criteria. The important criteria is also contains the possession, giving the possession of the immovable property. And just one point, I'm just reading the yellow and red portion, just have a look at it. General provision already I told you, when there is a transfer of a capital asset, capital gain will be computed. If it is short term capital gain will be computed and a normal rate is applicable. If it is long term, special rate is applicable. And the date on which transfer taken place, that date or quarter will be taken as the transfer, and accordingly the tax applicable. Even also shortfall of advance tax will be computed quarter wise in the your return you might have seen. But the provision talks about that notwithstanding contained in the section 1. So 1, whatever section we discuss, but where the capital again arises to an assessee, being an individual HUF family, Hindu undivided family, from a transfer of a capital asset, being land or building or both, under a specified agreement is the joint development agreement, the capital gain shall be chargeable to income tax as the income of the previous year in which certificate of completion of the whole or the part of the project is issued by the competent authority. So what already I explained to you, but still I am just recapitulating. If the same example I am repeating, the land has been transferred by way of a power of attorney on July 2023, let you take, and the consideration is received 50 lakhs cash, and let 40% houses to be received on completion. So that is not a date of a transfer. So that will be deferred. So up to which date it will differ? The date on which occupancy certificate has been received or completion certificate has been received from the competent authority. So competent authority depends upon state to state. Generally, it is the local development authority or the municipality, municipal corporation who has been delegated with the power of issue of the completion certificate. So in that case, if the house is completed in December 2026, then 26-27 year is the calculation of a capital gain. So the flat value will be converted to the value as a consideration, plus 50 lakhs will be taken as a total consideration, and then your cost of acquisition will be taken as per the provisions of the law, and accordingly the difference will be treated as a long-term capital gain or but second sentence just you see, suppose and again it is also clarified what is the value will be taken in the income tax. I'm not talking about GST. GST will be different provision. Now your stamp duty value on the date of issue of a completion certificate will be taken. So in December 2026, what is the stamp duty value? Stamp duty value means if any house in the same apartment or same flat project has been sold, that value will be taken as the stamp duty value for the purpose. If not, then nearby any transaction has been taken place in the registered office, that value will be taken. So it talks about that the date of issue of the said certificate, the stamp duty value will be taken, and accordingly the consideration is increased in addition to flat plus cash. So flat will be converted with the stamp duty value on the date of occupancy certificate or completion certificate plus consideration. So that will be treated as a total consideration for the purpose of computation of capital gain. But again, I'm telling, this is the one of the benefit deferral of the payment of tax in case of joint development agreement is given. But if the flat owner has been identified with the flat, many cases we found the flat owner is identified with the flat, let 40% flat, it has been identified. A block, let a first floor, every floor 1 let he received 25 houses in the first block, let 10 houses in the second block, 3 houses in the third block, balance houses in the fourth block. It has been identified with the number, the house number. But the landowner started to sell the house before the completion or before the occupancy certificate or the completion certificate, like the promoter. Sometimes it so happens. So in that case, defermental benefit means the computational capital gain on completion is not applicable. The moment he sold one houses, he tried to sell to anybody, receive the consideration, immediately it will be capital gain will be computed. So joint development agreement benefit is not applicable to the landowner. So landowner should be very particular that they should not sold their houses prior to the completion certificate. If they will sell, then what will happen? Instead of 2023, as you are calculating 26, 27, so that will not be going to be calculated. So my example which I have given July 23, computation will be made in the second quarter of the 23, 24, but because of ZDA, it is going to be computed in the third quarter of the 26, 27, because you transferred in December 26. So that benefit he was getting. So, but in this case, that benefit is not going to get it. So it will be taxed immediately. So that is the provision. With this back provision already we have taken. So stamp duty valuation, the government value means the value at which the flat has been registered nearer to the, maybe in the same project, maybe nearer to the project. So that value will be taken square foot basis for the purpose. And now what I am telling, the meaning of stamp duty value I already told. Cost of acquisition have a definition. Cost of acquisition means cost paid to the owner at the time of acquisition of property. If the property is acquired prior to 1st April 2021, then the cost of acquisition will be the stamp duty value as on 1st April 2021. That is at the option of the assessee can take, or the stamp duty, if it is more prior to that, that value can be taken. If the landowner has acquired the land or the building prior to 2000 from by way of as a legal heir, or the by way of a gift or will. So in that case or inheritance, cost to the previous owner will be taken as the cost of acquisition, and while the previous owner is prior to 1st April 2021, then the stamp duty value of 2021 can be taken to get the advantages of a price inflation. So that is the cost of acquisition. And indexation at present not available, particularly in case of immovable property, because of the new provision. So flat rate of 12.5% is applicable. So this is the I have given. So this you can see in the chart. Individual and HUF enter into a specified agreement for development of the project. So the Hindu undivided HUF or Hindu undivided family transferring his share in the project after the date of issue of a completion certificate. Before, if they are transferring, then it will not treated as space joint development agreement, and capital gain will not be deferred. And a capital gain of tax liability would be arising previous year in which certificate of completion has been issued. But in addition to that, just I wanted to tell you that generally the capital gain tax is computed quarter wise. In every return of income tax, you will find there is a quarter wise data has to be given, because according to the advance tax will be calculated. So if you defer it, then the penal interest under 234C because of shortfall of advance tax is applicable. So stamp duty value of the his share of the house will be taken. Already I told you what is the stamp duty value, and a full value of a consideration deemed to the cost of acquisition for determining the capital gain on subsequent sale of share by the development property. And similarly, the prior to sale cannot be treated as transfer to get the joint development agreement. So always two things you remember: wait up to the getting the completion certificate, occupant certificate, then you transfer it. Okay. And I am giving one example, but this I could not give time to revise. But the only theme is that I calculated the cost of sorry, capital gain, and accordingly, if it is after the uh, July 2024, so in that case the 12.5% tax is applicable. So you see, Mr. R has purchased a plot of land in September 97 for 5 lakhs. Fair market value 2001 is 10 lakhs. Why I told you the indexation earlier was made from 1981, but now it is to be made on 2001, 2001 only, April 2001. That's why 15 lakhs, 10 lakhs is very important. On 15 December 2018, he entered in joint development agreement with the promoter Khushi Builder, and he received the 2 flats in the development project along with the check of 40,000. So that means cash consideration 40,000, check consideration 2 lakhs, and the house will be handed over on 15 December. Sorry, the land was handed over immediately on 15 December 2018, and the stamp duty valuation of land was 30 lakhs. The certificate of completion for the said project was received November 2022. This example, but you can the same is the principle is applicable. Actually, when I have seen it was not changed, but you can also that's why but changing provision also I will make applicable here subsequently. The builder transfer the flat to landowner on 14th December 2022. So that means after getting the occupancy certificate, then it is transferred, and the landowner incurred expenses of 3 lakhs in connection with transfer is land. So the landowner incurred expenses because while you are computing capital gain, na, so in that case the expenses also to be taken as a deduction, and that is the consideration less cost of acquisition or index cost of acquisition. Index cost is not applicable at present, so less expenses and less in improvement also if he any further improve. So cost of acquisition is the land cost. If you building acquired is building cost, but if you acquire the land then constructed building, the cost of construction is the improvement cost. Land cost is the building cost. So this is the table you can just go through. So with this just simple way I calculated 50 lakhs is the flat stamp duty value. So into 2 flats it is 1 crore, 40 lakhs in check. So 1.4 crores is the consideration. Cost of acquisition, because 30 lakhs was the acquisition or the index cost of acquisition. So in that case it was applicable 30 lakhs into I made indexation, but now indexation is not applicable. And another point you remember, since indexation is not applicable, the flat rate will be taken for 12.5%, 1.4 crores later 30 lakhs, because 30 lakhs is the cost of acquisition in the 1st April 2021 that has been taken. But in this indexation provision is applicable, I made 84 lakhs. Cost of improvement assume nil, expenses 3 lakhs also to be taken, and then long term short term capital in 53 lakhs. So if it since it is more than 24 months, then it is long term capital gain. So the here you see what happens. As I remember, it is 20%. That's the capital gain tax was 20%, not 10%. But that 20% has come down to 12.5% without indexation. So with indexation, it was 20%. Without indexation, it is 12.5%. But again, I'm telling one question may be coming in your mind, which is more beneficial? Friends, for your kind information, just I tell, I have given one article after soon after the change of the provision, and I calculated if your consideration is more than 8 times, 8 times than your cost of acquisition. So in that case, you are going to lose, means you are going to pay more tax. But if it is less than that, then it may be beneficial. So 20% calculation or indexation with 20%, without indexation 12.5%, the criteria was roughly 800% is the consideration increase. So if you more than one is going to lose, just have a look at it. You can also calculate it. So government wanted to take a more revenue on this account. And another point, just I am telling, this is the income tax point of view, and you have to pay the capital gain. But there is another provision that when the under 194 IC, when the landowner handed over the land rights to the builder, so the flat will come. So no TDS on kind, but when the 40 lakhs check has been given, so there is a TDS, and TDS has to be deducted at the rate of 10%. So if the 10% TDS to be deducted, so that is nothing but an advance tax for you. The builder deposited, it will be come in your AIS or 26 ASA, and you can carry forward in your return. Mark the word carry forward in the return, because you are not going to show capital gain during the year of transfer. So only it will be carry forward, and it will be only shown as a advance tax adjustment in the year in which final computation will be made. And there is a PAN section 206 WF. If PAN number is not given, then it will be 20%. But as I remember in the budget 2025, perhaps this provision they have omitted. Please check up as I remember, because in case of a higher TDS, in case of a not providing PAN, perhaps deleted just to see. But there is a deduction of 10% is there when there is a transfer. So this has to be taken into consideration. This is a significant accounting issue. I am not talking, because if I talk to you, then I am going to miss the other provisions. So these two slides I will provide, you can see. So there is a, then the question will come indirect taxation, how it has impact. So your journey has been started in 2012. Positive list service tax, negative list service tax, GST implemented. Then your multiple notification has come in the 2019. It became very controversial, and taxability government wanted to take the revenue in this project. This is a high earning. So the I will discuss to the section 7 particularly provides that sale of land and sale of a completed building, and not the sale of immovable property from the purview of the GST. So it excludes actually. The section 7 provides. So friends, I think there is a perhaps. So now a lot of issue will come. So now we are going to discuss in the JDA. There is no completed house has been sold off, because the once the occupancy is high. So the when the alert is giving the house. Right? Just 1 minute. Friends, 2
Sir, you please share your screen.
Actually, how when it was disconnected?
Before 5 minutes ago.
That's why I'm telling. I wanted to know it. Just 1 minute. I shared it. I think it is visible.
Yes, sir. Yes, sir. Please.
So I will carry on now.
Yes, sir. Please.
I don't know how it is coming. Just have a look whether all attendance is there or not. Okay, ठीक है. This is showing now.
No, sir.
Hello,
No PPT is showing, sir.
just 1 minute. Some problem is there. It is showing. Hello,
One second. No,
not showing
no,
now.
sir.
Just see. It is showing.
Yes, sir. Yes, sir.
Okay, okay. So you just tell me whenever there is an issue, you tell me because I am not in a position to know whether it is showing or not showing. Okay.
Okay, sir. Oh, okay, sir.
So now I think it is okay. We can
Yes,
continue,
sir. Okay, sir.
and I will also repeat whatever I have not discussed. I will also repeat it. Okay.
Oh, okay, okay, sir.
Uh, Friends, I am sorry. I heard that it was not connected for 5 minutes. Just I'm going TDS, the tax deduction at source to be made when the cash consideration is given by the builder or the promoter to the landowner, and this TDS is deducted on each payment. Since the transfer under the provisions as we discussed will be taken place only after the handing over the kind portion of the flat, means the flat which the sharing of the flat. So in that case, to that year, the advance tax will be shown in the return and the TDS will be carried forward. And this TDS will be adjusted only the year in which the occupancy certificate or the completion certificate has been issued and the flats are handed over by the landowner to as by the promoter to the landowner. So computation will be made that year. After that, the two slides are there because of time. I am not discussing. You can go through it when I submit the slides to the institute and it will be displayed. Then I'm coming straight to the हैंग हो गया। हो गया ना? नहीं हुआ? मेरे को तो दिखा रहे हैं। हाँ, मेरे को दिखा रहे हैं। आपको नहीं दिखा रहे हैं? Let I am once again I am going. देखिए, रिक्वेस्ट भेजा है। एक्सेप्ट कर दिया। अभी आया ना? ठीक है, अभी दिखाता है। शोइंग ना? शोइंग ना? अरे क्या होता है? अभी तो ठीक है, वो तो नेटवर्क ठीक है। नहीं, नेटवर्क अभी तो ठीक है, तो अभी तो ठीक है। मैं थोड़ा आउट अब फिर चला जाता हूँ। आई विल कम बैक अगेन। हाँ हाँ, मैं विंडो क्लोज कर दूंगा। ओपन देखिए, दिस इज द प्रेजेंटेशन ओपन। मैं फिर देखता हूँ, जस्ट 1 मिनट। अरे स्टॉप करके मैं फिर जाता हूँ। हाँ, जस्ट देखो। आई थिंक नाउ इट इज विजिबल परहैप्स। बट इज शोइंग दैट। हाँ हाँ, बट इज शोइंग, मेरे को तो दिखाता है इट इज शेयरिंग। Then I am doing one thing. I am closing it. Okay, coming to opening the फिर वो फाइल को ओपन करता हूँ। ओके, जस्ट 1 मिनट। ओपन कर दिया, फिर शेयरिंग करता हूँ। Just see. Hello. Not coming. हाँ इंडेक्स दे दिया ना आप दे दिया हेलो
हेलो।
हाँ
आप आपको ये टीम
टीम खोलता हूँ शेयरिंग तो अभी है इज विजिबल अभी आया नाउ इट इज विजिबल ना अब फुल स्क्रीन नहीं किया अभी किया फुल स्क्रीन आता है मत देखा जाता है ना ठीक है मैं आई थिंक सम ऑडियंस है दे आर मेकिंग कॉल आई एम जस्ट टॉकिंग टू देम है हेलो हाँ हेलो कौन तो ମୁଁ ଟିକେ ପରେ କରୁଛି ଆପଣଙ୍କୁ फ्रेंड्स I'm sorry because of some network there is some issue. I'm just repeating. I think we have discussed in detail the taxability of joint development agreement under the Income Tax Act. Just I'm going to the GST implication on JDA agreement. So I am repeating it that Section 7 of the Income Tax GST Act contains the provisions regarding the supply. Schedule 3 of the Section 7 provides that the land and building on which GST is applicable, on which the GST is applicable. So, so in case of a joint development agreement, the land joint development agreement where the right is treated as a services provided builder means the houses which will be sold by the promoter and to the landowner share are treated as a construction service on which GST is also required to be paid. So in that case, under development right. So right to right to the promoter for development means construction of a new building, commercial or residential. So that is known as a transfer of development rights. So TDR we call transfer of development rights. So in case reverse mechanism. So from two this on that particular amount. Development rights. So the time certificate means the promoter is required to make the issued and TDR transfer of development right is then so what will happen generally is the point on which uh, as per the notification, the rate of tax is upper cap has been given, but 18% is the notification has been given regarding the construction services. And input tax credit is not available because there is notification. You can refer to told you once the development developer is the supplier of a service. Add 1.5% or 7.5% as the case may be. The two rates have been applied. The value will be determined as per notification number 11 read with notification number 3 by 2019. So the deemed to be equal to the total amount chargeable floor space index promoter. And while you are calculation in the land cost. So on land cost, the and sale of units to the end of the customer. Actually, what happens generally Once the house is construction is completed, the house is sold to the alert, actually the those who are booked the houses, and at the same time it is also given to the landowner. And already I told you, in case of area sharing basis, so in that case how it is going to happen. In one side the developer is there, the developer is selling the unit to the end customer. So when there is a 100% construction of a flat, 40% is given to the landowner, 60% remains with the promoter. Let in this example, the 60% flat usually sold to the new already, means the customer. So that means the ultimately the person who is receiving the house from the real estate project, so they are known as the customer for the developer. So in that case, and the second party is the landowner, whatever house he got, he can also sell the units to the end customer. The house owner has the landowner has the two options. He can keep the house, keep the houses which he got against the transfer of the land, and he can sell it, or he can keep it. So in that case, the GST implication is the supplier of a service is the developer or the landowner. If the landowner is selling, it is the landowner. If the landowner is not selling, it is the promoter. From your kind point of view, make a distinction from the income tax act point of view. When the landowner is selling before the occupancy certificate, then joint development agreement benefit, that is the deferral of computation of capital gain, is not available. So this is a situation where the landowner is selling the flats or booking the flats for sale, just like the developer. So that's why this tax implication, GST implication is there. But if the landowner, after getting the flats, after the completion or occupancy, then transferring, then it is a sale of immovable property which is not taxable. So in this particular example, it is the situation where the promoter is selling to the customer and the landowner is selling to the customer. So in that case, joint development benefit under the Income Tax Act will not be available. So the time of supply, as already we discussed, when the advance received, all the milestone payment received, that is the date of payment of GST. Suppose I am the developer and I development rights I got, I started construction, and later I am going to sell 60 flats. So you are booking the flat, giving me 10% advance. So then you are giving milestone. So on each 10% advance or milestone, I am going to pay the GST. Similarly, also applicable if the landowner is adopting the same means. And a value of supply, already we discussed. There is a provision of section 15, the valuation of supply. So in that case, a 1/3 value, that is the land value, will be taken as a deduction. Balance will be taken for the purpose of taxability. The tax rate is 1.5% or 7.5% as per the HSN as applicable. But again, I'm telling, if any units will be sold by the landowner or the builder, so in that case, no GST is applicable. Completion houses, the ITC of the GST flat will be allotted, but consideration also, sorry, construction cost also given pay the construction GST on in a this situation. Actually, there is a and this is another case, another situation, transfer of development rights. Already I told what is development rights. So once again, I am just repeating it. Development right means when the joint development agreement has been signed, and that is by way of general power of attorney, on basis of which the developer will go for getting the approval from the competent authority for start of the work. So now question is the development right also treated as a transfer on which GST is applicable. So the person liable to tax is the developer. In the development right, the RCM is applicable. Time of supply is the tax remitted up to the date of occupancy certificate, up to the date, but after occupancy certificate, there is no development right arises because already you and a value of supply is the deemed to be equal to the value of a similar apartments charged by the promoter from the independent buyer nearest to the date on which development right or FCI is transferred. Actually, already I told you since the nearest time on the date when the time of supply will come, that date will be taken for the computation. The provisions has been contained in the details in the notification. Some clarification FAQ also has been issued. You can refer it. Time constraints, it cannot be discussed, but I will propose particularly to the institute, we can hold a separate webinar categorically for the GST implication on development rights because income tax we have very detailed discussed. Exemption available proportionate to the unit is sold prior to the date of occupancy certificate. Actually, once up to the occupancy certificate, after unsold, any house remain unsold. So in that case, the tax is payable. Up to the occupancy certificate, any units is sold prior to the date of occupancy certificate. So in that case, tax is not applicable. And GST on TDR is limited to 1% or 5% of the value unsold unit on the date of OC or CC. So that is very important. So if out of 60, let the builder has only sold 45, 15 remains. So on that on 15 of the flat which remain unsold as on the date of occupancy certificate or the completion certificate. So in that case, either 1% or 5% will be charged. And the reason is once it is completed, subsequently the GST subsequently it become immovable property, stamp duty will be collected, and there is no payment of GST will arise in that case. So construction services already we discussed, it is also applicable to the same provisions. So this practical issue will not discuss, but one point I will tell. Cost of a transfer of a development right, there is a formula is there. So on that formula it will be calculated, and on development right the value of a landowner's units close to the date of JDA plus non-refundable deposit paid to the landowner into 18% will be taken, and the carpet area proportionate will be taken. So carpet area of residential apartment in the project which remains unsold, again I am telling, so only remain unsold on which the TDR will be calculated, and that is proportionate to the total carpet area of the residential apartment in the notification. You can see the second provision of the entry 41 of the notification 4/2019. So for further details. Similarly, cancellation of project, that is also TDR will be calculated once the project which is booked but not sold and it remains unsold on the date of occupancy, then on that the GST also to be calculated. That means that is the transfer of development right will be calculated. So one point you can keep in mind, transfer of development right will be calculated on unsold houses remains on the date of occupancy or the completion certificate. These units already we discussed. Then we come to the residential versus commercial house. What is the tax implication? Same, actually, whatever we discussed, the same provision is also applicable here. So I am not repeating it. The more or less the same provision. There is no change at all. The same provision is there. Another is uh, as already we discussed, in case of construction services, so in a commercial joint development agreement, the developer is eligible to avail and utilize the input tax credit. So now can the department, actually what happens now, there is a section 17 subsection 2 and section 17 subsection 3 of the CGST Act. So it talks about that there is a proportionate credit to be reversed. And section 16 talks about the ITC. Section 17 subsection 5 it talks about the block credit. Section 17.2 or section 17.3 talks about that when there is a common input tax credit, common ITC, and there is a proportionate ITC to be reversed if it is exempted supply. So land is when the a flat has been sold, so it also includes land and building, land and construction services. So now question is, can the sale of land be considered as a supply made by the landowner and not by the developer? That is the issue. And if it is not by the developer, it is not a way of a construction service, the department can make a dispute that proportionate ITC can be reversed. So this is one of the issue still remains. Then GST on commercial product, commercial complex. So what is the GST? The principle remains same, but just I'm repeating. So when there is a transfer of development right, and the transfer of development right in case of commercial project, so how the tax is liable to be paid? Now, the supplier of a service is the landowner. The person liable to pay, that means the RCM entry will apply. Actually, the residential property RCM is there. So landowner under forward charge, the issue remains because section 17 talks about levy of the tax. So whether deferment benefit under section 6 by 2019 can be taken, that is the time of supply has to be referred. नहीं वेबिनार खत्म नहीं हुआ एक्चुअली मीन टाइम देयर इज ए अप टू 1 hour there is no issue but after 1 hour there is a lot of disturbance even also I could not माने lot of disturbance disconnect हो गया अभी slow हो गया but up to 1 hour there is no issue still is there but I wanted to complete it but because it is a income tax implication and the GST implication. So income tax implication to my understanding was completed very nicely, but GST implication start करने का time में थोड़ा problem हो गया. But I am trying to complete it closely, but we can once again only GST implication we can hold, not now, later after some day, some month. Okay. Friends, actually today there is a lot of disturbance, particularly when we started discussion after 1 hour. These are the issues are there, but I am trying to concentrate. But once again, also we hold particularly GST impact on development agreement, joint development agreement. But still, then since we started, let us also we can continue now. Actually, now question is transfer of development right, particularly in case of a commercial area sharing, when the proportionate area has been shared, not intended for sale, whether that will be only area sharing. I am talking intended for sale, so that is already we discussed. So whether the GST implication will be there or not, and this is a very controversial area. And now question is the time of supply, actually section 13 is there and you can refer section notification 6 by 2019 for the details. Valuation purpose section 15 and read with section 27 and rule 30 will be there. Cost value will be taken for the purpose. 18% SSN 9972 is applicable. It is not available because it has been restricted in the particular project. And the same is applicable, the similar provision is applicable to the landowner when the continue construction services, because always in the JDA, two parts are there. One is the TDR, one is the construction services. So some issues are there. I'm not going to discuss. I'm going to discuss one of the important point on this particular issue. Friends, I'm summing up because of some disturbance. I'm summing up. Now, just I'm summing up, and the theme you can just note down it. In case of joint development agreement, it is mostly on air sharing or the flat sharing. The landowner handed over the development right to the promoter with a condition that a certain portion of the area will be shared in addition to the consideration in shape of cash. In the GST impact, it has two impacts are there. One is when the TDR transfer of development right will be there, and the developer on the basis of transfer of development right applied to the development authority, getting a permission for construction after approval of the project, started construction, incurred the construction expenditure. In that case, there is some restriction in the ITC, and that certain condition to be fulfilled to get the ITC in case of construction services. That part I am not discussing here. But during the construction, they also booking their share to the end customer who are going in the installments. So it has two parts. One is the taxability of transfer of development rights. The second part is the taxability of the construction services. So construction services is subject to the GST at the rate of 18%. And again, I am talking in the case of sorry, at the rate of special rate, specific rate as per the notification. As already I given, it depends upon different projects, 1% or 5%, and depending upon the floor space, the rate is applicable. And in case of development rights, the rate is applicable 18%. And development right is applicable only the flats remain unsold after the occupancy certificate or the completion certificate. Occupancy certificate and completion certificate, basis on which the valuation to be made for the stamp duty purpose, as already discussed in the computation of taxability under Income Tax Act. But in addition to that, what happens when there is a transfer of development rights, or we can say transferable development rights? So that means the case of additional floor space index means additional transfer of rights will come subsequently increase in the carpet area. So in that case, how it is going to be taxed? So this slide just very shortly I am going to tell. Transferable development right means certificate issued in respect of category of land acquired for public purpose either by the central government or state government in consideration of a surrender of land by the owner without monetary compensation, which are transferable in part or whole. And in case of transfer of development right means supply of a development right by the owner to the land to a developer builder for constructing a completion building or civil structure. So now here, first part, the second point is very clear. So I have let a 5,000 square, let 50,000 square foot of land. I transfer it to the developer or the builder, and the developer builder, when I transferred, a general power pattern has been given. So TDR right has been given to them. Taxability will come on the whatever remains after the occupancy certificate or the completion certificate. But in case of transferable development rights, so a certificate issued in respect of category of land acquired for public purpose. So that is a, and either by central government or state government in consideration of a surrender of land by the owner without monetary consideration, which are transferable in part or whole. So in that case, what will happen? Now transferable development right certificate is also referred to as additional FCI. So first, say index a certain additional space construction has been allowed in that case. The additional FCI is on par with the treatment of transfer of development rights. So it is equivalent. Initial rate it is given to construct let 1 lakh square foot. Then subsequently it is allowed to 1 lakh 10. So that 10,000 will be treated as if it will be a development right. So on which the taxability will arise. Actually, a recent judgment has been passed by the Telangana High Court in case of Prahita Construction Private Limited versus Union of India. So in that case, the issue raised constitutional validity and other issues are there, and which is subsequently disputed, and the matter is pending for the Supreme Court. So a FAQ on real estate released by the tax research unit of Government of India by the file number 354. And what is that? That is very important. Whether GST is leviable on the output supply of transferable development rights by a developer, usually evidenced by TDS certificate issued by the authorities, EPS under which entry and at what rate. The GST is payable on transfer of development rights by a developer to another developer or promoter or to any other person under reverse charge mechanism at the rate of 18% with the ITC as per the notification. So 18% means ITC, lower rate in construction services, no ITC is to be allowed. And this is the issue actually there. The issue is the developer under the RCM. These issues are still there. I am not covering it. So special issue we are not going to cover. And this is the transitional project we are not going to cover. Actually, transitional project 2019 has been taken as the point for the purpose of transition. The project which already started, but subsequently it is continuing. So that the specific provisions are there. So friends, actually more importance given in this presentation regarding the taxability of joint development agreement under income tax. Very few provisions coverage I made regarding the taxability of the GST, keeping in the view the time constraints. But I will request TRD to specifically have a webinar, not now, after maybe 1-2 months, on the GST implication on the joint development agreement or real estate project, which can be held separately. I'm sorry for the internet disturbance. Actually, I could not also concentrate because of the frequent disturbance made, which never happened earlier. First part was over up to 1 hour, but subsequent 30 minutes and so far I think 40-45 minutes was very disturbing. So it is beyond my control. Thank you very much. If any chart is there, let us also, I will try to, I think it is disconnected perhaps. Any chart, just I wanted to have the answer. Administrator joined the conversation. If anybody has any discussion, you can also have Okay.